If you rewind a couple of weeks, even just quantitatively, like if you look at some of the sentiment surveys, sentiment today is more bearish than it was in the financial crisis. And I can tell you just anecdotally, like being online and Twitter, like people are predicting the end of the world. Like I've never seen sentiment so bearish, which is bullish. It's absolutely bullish. Thursday, October 13th, we had the CPI number. It was expected to come in at 8.1. It came in at 8.2. The futures were down 100 pre-open. The market opened at 3,500 and immediately had a big reversal, like a 5% reversal intraday. And that has been the low. And there's a lot of shorts trapped at that level. The Bank of Canada had a 50 basis point rate hike instead of a 75 basis point rate hike, which is, now if you remember, the Bank of Canada hiked rates before the Fed and hiked rates faster than the Fed. They even had a 100 basis point rate hike. And they're going to be leading the Fed on the way down. The fact that they hike 50 and 75, the central banks communicate with each other. They all respond to the same factors. And the fact that the BOC is getting more dovish at this point, we have the Fed meeting next week on November 2nd. There's really only a 5 or 10% chance priced in that the Fed's gonna go 50 instead of 75. But if they do, I can tell you the market is absolutely going to rip. And actually what I think is the most likely scenario is they'll probably go 75, but their forward guidance is going to indicate that they're almost done with rate hikes. So
I agree 100% with you. Whenever we get that, whether it's a surprise or whether it's the guidance going forward that surprises Wall Street, that's the time when it's, you take that black cloud and still hanging there, but some sunshine coming through there. And looked at the numbers that if CPI month over month, going forward, the month over month numbers were flat, just zero, continuing starting October and going forward, we would be down in April to about 2.3%.
yeah,
Even if it goes up 0.3% a month, which is above the average of the last 3 months, we'd still, by I think it's June, be down to 2%. So we're on a path that it's going to get there. It's just, I feel like what the Fed, and not that I'm saying the Fed did a good job by means, Jared, but it's going to work its way in. We're starting to see commodity prices roll over, rent starting to roll over, housing prices starting to roll over. And do you think that investors will start moving in sooner rather than later in anticipation of what we're discussing here?
the Fed doesn't really look at CPI because CPI doesn't tell you what is happening today. It tells you what is happening 4 months ago. And as you mentioned, even if we have small increases in CPI, it's going to go down a lot in the next 4 months. But having said that, I think people underestimate the short positioning in the markets. And right now, the market is about 8% off the lows. And I see the shorts on Twitter and they're in disbelief mode. It's just it's a bullshit bounce. We have to short, it's going to make new lows. I see a lot of talk about earnings. Earnings have been bad. Earnings have been bad, but stocks are up because expectations for earnings were so low that it was impossible not to beat them. So that's where we are today.
Jared, you talked about sentiment today in your presentation out of Washington. It was a fantastic presentation. I also talked about the AAII, American Association of Individual Investors, how negative people are looking out 6 months from here. And I'm a contrarian investor as well. And we could show anything from the amount of puts being bought to the amount of cash in the sidelines, institutions, to CEO surveys, everything's so damn negative. I know that doesn't predict a bottom saying here's the bottom. That being said, historically, does that tell us that we're at maybe a sweet spot near a bottom?
There's actually another sentiment indicator that I saw, a new one, assets under management for leveraged ETFs. So leverage long ETFs versus leverage short ETFs. And assets for leveraged short ETFs are at the highest ratio to long ETFs in history. Wow. So that's another one. It does look like what I do with sentiment trading is the sentiment gets me in the neighborhood of a bottom or a top. And then I will use technical analysis to get more scientific about an entry point. And two things that I do, I use DeMark indicators and I use MACD, moving average convergence divergence. And when those line up along with the sentiment, that gives you a pretty clear buy signal. And you can actually get within a day or two of the top or bottom.
Did you have a buy?
One of the things I've been focused on recently is Europe and emerging markets. So if you think about what's happened with valuations in the US relative to Europe over the last 15 years, like valuations in the US have gone straight up and in Europe, they've gone straight down. And in Europe, you have this, I coined a term for this. but I call it when you have stocks in the 6-6 zone. And the 6-6 zone is when you have stocks with 6 PEs and 6% dividend yields.
Oh, wow.
And Europe is full of cheap stocks that have 6 PEs and 6% dividend yields. Now, Europe is kind of a disaster right now with the energy situation and stuff like that. But if you're a contrarian, you say, look, if I want to invest for 10 years, really in Europe today is like 1982 in the US, right? Where you have, remember that magazine cover, The Death of Equities,
Yeah.
right? And nobody would invest in stocks anymore. That's what it's like in Europe right now. So that looks attractive. Same thing with emerging markets. If you go back 2002, 2003, emerging markets were like all the rage. You had the BRICS, you had Brazil, Russia, India, China. Like you had this decade of growth in emerging markets. And this year, the dollar has gone up 25%. Emerging markets have been killed. But if you start to dig into some of these emerging markets, ex-China and ex-Russia, but like Brazil in particular, like you have stocks with double-digit dividend yields, like incredibly cheap stocks. So there's a couple of ETFs that I picked for the newsletter. I said, look, if you just buy this stuff and you just clip like 6% coupons and the dollar starts to sell off once the Fed starts to cut or at least pivots, like that's going to be a great trade over the next 5 years. I used to be a trader at Lehman Brothers. I used to run the ETF desk. And when I started running the ETF desk in 2004, my boss at the time, who was the head of derivatives, he said, your job is not really to be a trader. Your job is to market the business, right? So I wasn't a marketing major. I'm like, what the hell? Do I put up billboards? Do I take out like ads? Like, what is he talking about? So I got an idea. So I said, I'm good at writing. So I'm going to start sending out this market commentary and I'm going to build a following. That's what I did. So for 4 years, like I sent out these Bloomberg messages and they went viral. And at the end of my time at Lehman Brothers, I had several thousand people on my distribution list. I was offered a job to stay at Barclays and I said, no, I'm going to start a newsletter. So I said to my subscribers on that list, I said, I'm going to start a newsletter. So join me at the Daily Dirt Nap. And I want to say 10 or 20% of them did.
Yeah.
And that formed the basis of it. And that was in 2008. That was 14 years ago. So now I have about 4,000 subscribers and it's been good. I've only had good experiences.
Okay.
I want to say I've had about 10 or 12 Airbnb rentals and everything has always been great. Really, I think Airbnb has the potential to do what Tesla did to the auto industry. Now, if you remember when Tesla first started to rip, people were making these calculations. They were like, Tesla is worth more than Ford and GM and Volkswagen. It's worth more than the entire auto industry. That doesn't make sense. Airbnb is going to do the same thing to hotels. It's going to be worth more than Hilton, Marriott. It's going to be worth more than the hotel industry combined. When Airbnb went public, it was pretty expensive. It's gotten a bit cheaper, but when people look at it, if they just look at a straight PE, it's 29 or 30 or something like that. It's still on the expensive side. Like this stock is growing very rapidly, and it is going to be bigger than the entire hotel industry over 10 years. So I don't really get too wound up in the volatility. I'm actually down money on it right now. I want to say my cost basis is around 135 or something like that. So I'm down a little bit, but I'm not touching that for 10 years.